business owners assume their commercial property insurance will pay to rebuild after a loss, and most of the time it does. But here's the number that changes the conversation. Independent analysis have found that a large majority of commercial buildings, in some studies as many as 75 to 90% are underinsured, and many of those by 25% or more. That means the majority of businesses with property insurance will receive a significantly smaller check than they expect the day that they actually need it. But here's the twist for 2026. Commercial property rates have started to actually come down industry-wide after several hard years, which is generally good news, but easing rates says nothing about whether your insured values are current. A cheaper renewal on out-of-date numbers is not a win. Buildings, equipment, inventory, tools, tenant improvements, and furniture are often the physical foundation of a business. They represent years of investment and daily operational dependency. When something happens, a fire, a storm, a burst pipe, and overnight theft, the question isn't just whether there's a policy. The question is whether the policy reflects what it would actually cost to replace everything today. Because property values don't stay static, construction costs don't stay static, and policies that aren't updated to reflect current reality payout based on the values that were reported, not the values that exist. Commercial property insurance covers the physical assets a business owns or is responsible for against a loss or damage from a covered cause. In plain terms, if a covered event damages or destroys your building, equipment, inventory, or other property, the policy pays to repair or replace it up to the limit stated in the policy. The core components of most commercial property policies are the building itself, including permanent fixtures and systems, business personal property, everything inside that isn't attached to the building like equipment, furniture, inventory, tools, computers, and supplies. Tenant improvements and embedments for businesses that lease space and have made modifications or upgrades to a rented location. And business income and extra expense coverage, which replaces lost revenue and covers ongoing expenses if the business has to close temporarily after a covered property loss. Now the data. Research from Crow's property appraisal analysis cited by the Insurance Information Institute have found that the large majority of commercial buildings studied were underinsured. With a significant share underinsured, about 25% or more, part of the reason is straightforward. Construction material costs have run well above pre-2020 levels for years now. According to the BLS data cited by multiple carriers, most property valuations are not recalculated annually. They're carried forward from older estimates that no longer reflected what rebuilding would actually cost, even as the rate environment shifts around them. Commercial property coverage applies only to the causes of losses defined in the policy. The form of the policy, special, broad, or basic, determines how wide that protection is. A special form policy covers all causes of losses that aren't specifically excluded, making it the broadest available. A basic or broad form policy covers only the named perils listed, and if the cause of a loss isn't on the list, there's no coverage. Most businesses should be on the special form. When they're not, or when they don't know which form they have, that's a gap that matters. Here's what standard commercial property does not cover without a separate policy or endorsement. Flood, explicitly excluded in virtually all standard commercial property forms, requiring a separate policy through the National Flood Insurance Program or private markets. Earthquake is excluded in most standard policies and requiring a separate endorsement, particularly critical in high-risk regions. Mechanical or electrical breakdowns, since property policies cover external damage events, not internal mechanical failure. Employee theft, typically excluded and requiring crime insurance or employee dishonesty coverage. And cyber losses, since data, software, and digital assets are generally not covered under property policies at all. And then there's the coinsurance clause, the most consequential policy feature most business owners have never been fully explained. Most commercial properties include a coinsurance requirement, typically 80, 90, or 100% of replacement value. What this means is if your building will cost $1 million to replace and your policy limit is $600,000, you don't just lose the gap above $600,000. The coinsurance formula applies a proportionary penalty to every claim, including partial losses. At a standard 80% coinsurance requirement on a $1 million building, you should carry at least $800,000 in coverage. If you only carry $600,000 and file a $200,000 claim, the penalty formula pays you 70 cents on the dollar, meaning you receive $150,000, not $200,000, even though that partial loss was fully within your policy limit. That $50,000 shortfall comes directly out of your pocket, and it happens not because the loss wasn't covered, but because the value was understated when the policy was written. A restaurant sustains fire damage estimated at $300,000. When the claim is filed, the carrier determines the building should have been insured for $1.2 million. The policy only carries $800,000. The coinsurance penalty reduces the payout by a third. The owner absorbs $100,000 out of pocket on a claim that was otherwise fully covered. A retailer's inventory and equipment are destroyed in a fire. The policy was written 3 years ago. Construction costs and equipment replacement costs have risen significantly since. The current replacement value is well above the limit on the policy. The business collects a fraction of what it needs, and the rest comes from reserves. A pipe burst in the leased office space over a long weekend. Water damages the tenant's custom build-out, furniture, and IT equipment. Without tenant improvement endorsement on the policy, the build-out which the tenant paid for isn't covered under property. The tenant's GL doesn't cover it either. It falls through. A storm causes roof damage at a manufacturing facility. The business has been closed for repairs for 6 weeks. Without business income coverage or with limits that were set too low, rent, payroll, and loan payments continue while revenue stops. The gap between what the policy covers and what the business actually needs to survive is material. A business owner celebrates a lower renewal premium in 2026 as property rates soften across the market. Without realizing the carrier priced that renewal off the same 3-year-old statement of values, the premium went down. The coinsurance exposure did not. The next claim will be adjusted at today's replacement cost, not the number on the declarations page. Commercial property is one of the most consistently underbuilt coverages we review, and the mistakes almost always trace back to the same root causes. Property values never updated. The single most common and most costly gap. Replacement cost estimates are typically calculated at policy inception and renewed without recalculation. In an environment where construction costs remain well above where they were 5 years ago, that gap compounds every year. Even as premiums themselves may be trending down, replacement costs versus actual cash value, not discussed. Replacement cost pays to rebuild with new materials. Actual cash value factors in depreciation. On older equipment or buildings, ACV can produce a dramatically smaller settlement than the business expects. Most businesses should be on replacement costs, but not all are. Business income limits not tied to actual financials, the period of restoration, the revenue at risk, and the fixed expenses that continue during closure must all be modeled against real numbers. Generic limits almost always fall short. Tenant improvements not addressed. For a business that leases and invests in their space, tenant improvements are often uninsured or significantly underinsured without a specific endorsement. Coinsurance not explained or managed. The most dangerous gap in the entire commercial property conversation. When values aren't current, the coinsurance clause doesn't just reduce the total payout, it reduces every partial loss claim by the same proportion. And flood and earthquake exclusions is not addressed in high exposure areas. For businesses in flood zones or seismically active regions, these aren't remote scenarios. They're the most likely and most catastrophic losses, and they are specifically excluded from the standard policy. At Corey Washington & Company, we evaluate commercial property coverage based on real replacement costs, not the estimate from 3 years ago. We model business income limits against actual financials. We review the form type, the cause of loss, the coinsurance structure, and every endorsement gap that a standard policy may leave open. We identify whether flood, earthquake, or equipment breakdown exposure needs to be addressed separately, and we explain the coinsurance clause before a loss, not after. Because the goal isn't just to have a policy, the goal is to have a policy that actually covers the business. Property insurance should protect more than the building. It should protect the future of the business. If you own or lease commercial space and you're not confident your property values are current or your policy is structured correctly, that's exactly the kind of review we do. Link is in the bio. Let's build your program the right way.